You ever look at a financial report and feel like you need a decoder ring?
Absolutely. All those numbers and acronyms.
Right. It can make your head spin. Well, you're in the right place. We're here to be your guide today, kind of cut through all that jargon.
Mm-hmm.
Today, we are taking a deep dive into the second quarter 2025 financial results from Equifax. And this isn't just about the numbers themselves.
No, it's really about understanding how this huge global data and analytics company is actually navigating, well, a pretty complex economic landscape right now.
Exactly.
So our mission for you today really is to pull out the most important nuggets of knowledge, maybe some surprising facts from the sources. We've got the full earnings call transcript and the official press release, both hot off the presses from July 22nd, 2025.
Absolutely. Think of this as your shortcut, your essential guide to getting properly informed about a company that, let's face it, plays a really integral role in the whole global economy.
Yeah.
We're going to dig into what these results actually mean, not just for the market overall, but, for you. Right. And what's really interesting here, I think, is that even with all the headlines about, a weaker mortgage market, maybe a tough hiring scene, Equifax actually posted its highest ever quarterly revenue.
Yeah, highest ever.
Driven by apparently strong growth and innovation. So, okay, let's unpack this. What's really going on under the hood here?
Well, what's fascinating, first off, is just the sheer scale of it. Equifax had a remarkably strong second quarter. Revenue hit $1.540 billion.
Wow. Billion with a B.
Exactly. And that's up 8% in constant currency. So, taking out the currency fluctuations to see the core growth, and 7% is reported.
Okay.
And like you said, this isn't just strong. It's the highest quarterly revenue in their history.
Right.
And it came in $27 million above the midpoint of their own guidance from back in April, even with those, headwinds everyone's talking about in mortgage and hiring.
That's a pretty significant beat then. And I saw their adjusted EPS, the earnings per share, that also looks strong, like $2 a share.
Yeah, spot on. $2 a share, which was 10 cents above their guidance midpoint too.
Okay, so what does that tell us? Does it say something about how they're managing things internally, like costs?
Oh, it speaks volumes about their discipline, yeah. They managed some really solid cost control, which led to an adjusted EBITDA margin of 32.5%.
Okay, EBITDA. Remind us quickly.
Right, earnings before interest, taxes, depreciation, and amortization. It's just a key measure people use to look at a company's operating profit, kind of the core profitability.
Got it.
And that 32.5% margin, that really highlights their operational leverage. It shows they're squeezing more profit out of each dollar of revenue, even when things are, a bit tough out there.
So connecting the dots then, where did that extra revenue strength mostly come from, beating their own forecast like that?
Well, a big chunk of that outperformance actually came from the U.S. mortgage segment.
Really? Despite the market?
Yeah, particularly within their USIS business. That's their U.S. Information Solutions division. They saw stronger growth than they expected in things like pre-approval products.
Ah, okay.
And the overall market, yeah, it was still down, but it actually performed a bit better than they'd factored in. Like hard credit inquiries were down about 8.5%, but they'd braced for maybe an 11% drop.
So better than feared, basically.
Exactly. And beyond just mortgage, the non-mortgage growth was also pretty solid across all their business units. Workforce Solutions really stood out, driven by government work and consumer lending.
Okay, so they found ways to grow even with those known headwinds. It sounds like innovation must be a really critical piece of this puzzle for them. Their new Product Innovation Index, the MPI Vitality Index, hit 14%.
Yeah, 14% for the quarter, which is, get this, 400 basis points. That's 4 whole percentage points above their long-term goal.
Wow, that's huge. What's driving that kind of success with new products?
So this raises a really interesting question, right?
Yeah.
How are they hitting this consistently? And they pointed directly to their EFX.AI capabilities, basically their AI push. They're saying it's powering these new solutions by leveraging their unique Equifax data, all within their sort of single data fabric setup.
Okay.
A great example is their new Twin Indicator mortgage credit solution. They've already launched it.
Twin Indicator, okay.
Yeah, and they're apparently on track to roll out similar things for auto and personal loans using this Twin Indicator later in 2025. And this solution, it seems genuinely different because it combines like traditional credit data, alternative data sources, and these twin income indicators all into one package.
Right. And they seem pretty confident about this. I saw they actually increased their NPI vitality outlook for the whole year for 2025, bumped it up from 11% to 12%,
That's right.
which they pointed out is double what their index was before they did this whole cloud transformation.
Exactly. It's a massive shift.
So this isn't just a number. It feels like a fundamental change in how Equifax is using that cloud investment to not just, get by, but actually thrive even when markets are challenging. What does this level of innovation really mean for them competitively long term?
Well, it means they're fundamentally reshaping their business model, I think. And this transformation is not just about launching new products. It's also driving efficiency, strengthening their finances.
Right.
Like they bought back $127 million worth of their own shares this quarter. That's part of a new $3 billion share repurchase program. So in total, they returned about $190 million in cash to shareholders.
Mm-hmm.
But interestingly, despite that strong first half, they're actually keeping their full-year constant currency guidance the same.
Oh, why is that?
Well, they pointed to broader economic uncertainties, things like inflation, tariffs,
Yeah.
the usual suspects. But they're increasing their reported revenue guidance by $35 million and adjusted EPS by 3 cents a share, mainly because foreign exchange rates have moved in their favor.
Ah, okay. So a bit of caution mixed with acknowledging the currency tailwind seems prudent.
Yeah, exactly. A balanced approach.
Okay, let's maybe zoom in a bit on their Workforce Solutions segment, EWS. Revenue there was up 8% in the quarter. What were the sort of standout parts within that division?
Verification services really led the way there, 10% revenue growth.
Okay.
And government revenue, specifically, saw really impressive growth, 14% in the quarter. That's a big jump sequentially, like 12 percentage points higher than the previous quarter's growth rate.
Wow, 14% in government. What's behind that?
Mostly fueled by a ramp-up in Social Security Administration volumes.
Ah, the SSA.
Yeah, and also increased use by state agencies of their twin solution, plus just record growth and some pricing power. They mentioned a new SSA amendment, for instance, annual contract value around $50 million, which lets the SSA keep using that twin solution for checking monthly income and employment for disability benefit recertifications.
That sounds like a really solid long-term business line, doesn't it? Especially with the government always focused on managing payments correctly.
Absolutely. Very sticky business.
But, okay, on the flip side, Talent Solutions revenue, that's the hiring side, right, was only up about 4%. What's the story there with the job market?
Yeah, so U.S. hiring, especially for like white-collar jobs, it stayed pretty subdued in Q2. The official BLS data only showed a small increase compared to last year. Now, within that, their underlying employment verification revenue actually grew by low double digits, driven by new records and products, which is good.
Okay.
But that was partly offset by a decline in their insights revenue, which is linked to criminal background screening.
Ah, so fewer background checks happening.
Not exactly. It wasn't a slowdown in checks overall, but more about sort of share shifts between the background screeners themselves. Apparently, one of their big customers lost a client, and that client then moved to a different screener who just doesn't happen to use Equifax for court records.
Ah, okay. So it sounds like more of a specific client thing, a dynamic between those screeners rather than a fundamental problem with their core verification business itself.
Precisely. That's how they framed it. And they did mention that hiring transactions have slowed down a bit more just over the past month or so.
Okay.
That impacts both Talent Solutions and their employer onboarding businesses. They think that's linked to the broader economic uncertainty again.
Right. Makes sense.
But, despite the weak overall mortgage volumes we talked about, EWS mortgage revenue. So, verification for mortgages still climbed a strong 9% in the quarter, again, benefiting from record growth and pricing.
Interesting how they keep finding pockets of strength. And what about consumer lending within Workforce Solutions? That looked like a big jump, too.
Yeah, consumer lending revenue in EWS was up a very strong 19% in the quarter.
19%.
Yep. Double-digit growth in personal loans and cards.
Yep.
High single-digit in auto. And again, it was driven by continued strong growth in the number of records they have, new products, getting deeper into the market, and strategic pricing. They mentioned their Keylon products specifically saw strong growth from bigger customer volumes.
That strong performance in government services, though, going back to that sounds incredibly promising for the future, right? Especially with this ongoing focus on preventing improper payments, whether it's social services or tax credits.
Oh, absolutely. They seem deeply engaged in Washington, D.C., supporting new federal programs. They mentioned things like the IRS Earned Income Tax Credit Do Not Pay portal,
Okay.
unemployment insurance initiatives, Department of Education stuff. And they also see big opportunities to expand that twin utilization at the state agency level, too,
Right.
especially with a new integrated income solution they're launching in Q3. It's designed to help states validate income from like gig work, self-employed people, non-W-2 income using consumer permission bank data.
That Q3 solution sounds like a potentially big step. But you mentioned earlier there's still some lingering volatility in government revenue. Something about funding changes from the prior administration, is that still playing out?
Yes, that's definitely a dynamic they're navigating.
Mm.
They expect government revenue growth in the second half of the year to be kind of consistent with the first half as states continue to sort of manage through those funding changes.
Okay.
They acknowledge it's a complex environment because you've got different state budget cycles, shifts in who pays for what,
Mm.
cost-sharing responsibilities
All
changing.
right.
However, they sounded very confident about their medium and long-term growth prospects for EWS government revenue. They expected to grow faster than their overall EWS long-term target of 13% to 15%.
Hmm.
They're really aiming to grow into what they see as a large, like $5 billion government total addressable market.
5 billion. Okay. Let's shift gears then to their USIS segment, U.S. Information Solutions. They also had a really strong quarter, revenue up 9%, and you said largely driven by mortgage. How did they pull that off in what most people see as a pretty tough mortgage market?
Yeah, it's quite something. Mortgage revenue in USCS was up a very strong 20%.
20.
20%, mostly from third-party vendor pricing, apparently,
Hmm.
and stronger pre-approval products,
Hmm.
even though, as we said, overall, U.S. mortgage hard inquiries actually declined about 8.5%.
So they must be gaining share then,
Yeah.
particularly in that pre-approval space.
Seems like it. Yeah, USIS is clearly gaining market share there,
Yeah.
and they expect that momentum to actually accelerate in the second half when they roll out their new mortgage credit file that integrates that twin indicator we keep talking about.
That twin indicator really seems like a key differentiator for them, enhancing their basic credit file.
It really does seem to be. They're reporting strong interest from the mortgage market, with lenders actively, integrating it into their systems, their workflows.
Mm-hmm.
And importantly, they plan to deliver this twin indicator alongside the credit file at no extra cost.
Oh, interesting. So the goal is just driving more volume and market share gains.
Exactly. And USIS also saw real benefits from their cloud migration on the cost side, too. Their adjusted EBITDA margins increased by 180 basis points, up to 35%.
Wow, 35% margin in USIS.
And their NPI vitality for USIS also picked up, hitting 10%, which is right in line with their long-term goal for that segment.
Okay. Now, despite all this strength, especially in mortgage revenue, they are still forecasting a decline in mortgage hard credit inquiries for the second half of 2025, right? What's the specific outlook there?
Yeah, that's right. Their guidance assumes a decline of over 13% in hard credit inquiries in the back half of the year.
Oof, okay.
It just reflects the reality of, continued low levels of home buying and refinancing activity. 30-year mortgage rates are stubbornly above 6.7%. Housing prices still high.
Yeah, the usual story.
Right. But they did make an interesting point. They believe there are almost 13 million 30-year mortgages out there that were issued since 2022 with an interest rate above 6%.
13 million.
Yeah, and about 9 million of those are above 6.5%. So this creates a really significant and growing pool of mortgages that are kind of ready to be refinanced whenever rates do eventually come down.
Ah, so potential future upside baked in there, even if it's not happening right now.
Exactly. A lot of pent-up demand, potentially.
Okay, speaking of the broader market, what's happening with their non-mortgage business within USIS?
Non-mortgage revenue there was up over 4% in the quarter. They describe the lending environment as generally stable, though still kind of below long-term normal levels.
Okay.
Auto showed high single-digit growth, which is pretty good. Financial institutions like banks saw low single-digit growth. Their financial marketing services, that's their business-to-business offline segment, was up 6%, with strong double-digit growth in pre-screen marketing.
Interesting.
But also interestingly, they haven't really seen a big increase in portfolio review spending yet.
What does that usually signify?
Well, typically, when lenders get more nervous about the economy, they spend more on reviewing their existing loan portfolios to manage risk. The fact that Equifax isn't seeing a big uptick there might suggest lenders aren't, perhaps, overly concerned about widespread defaults right now.
Huh. Okay, that's a subtle indicator. I also noticed some mentions in the call about higher corporate expenses, specifically related to litigation costs. What's driving that, and is it a big deal?
Yeah, they mentioned that it seems to be a combination of sort of general litigation costs from ongoing lawsuits, plus a higher volume of small claims coming directly from individuals.
Individuals suing more.
Apparently, they believe this higher volume of individual small claims is actually an industry-wide trend. It might indicate a broader shift in how consumers are pursuing claims against credit bureaus.
Okay.
And the cost of resolving these cases has gone up. They expect these higher litigation costs to continue hitting them in the third and fourth quarters and potentially stay high for a while, especially for these smaller consumer cases.
Okay, something to watch then. Moving internationally quickly, revenue there was up 6% in constant currency. How did the different regions look?
Latin America really stood out, leading the way with strong 11% revenue growth. Argentina and Brazil were particularly strong.
Okay.
Their Boa Vista business in Brazil, which they acquired, is apparently performing exceptionally well. And they mentioned it's integrating new Equifax platforms like Ignite, Interconnect, and the Equifax Data Fabric.
So the cloud tech is going global too.
Exactly, showing the global impact of that transformation. Europe also improved nicely, up 6%, and Asia-Pacific did well, up 4%. Canada, however, only grew 1%.
Only 1% in Canada. Why so slow there?
Yeah, continues to be impacted by just weaker economic conditions up there. They specifically linked it to ongoing tariff discussions and maybe lower consumer confidence in that market.
Okay. And presumably the cloud transformation is helping international margins too.
Indeed it is. International adjusted EBITDA margins were up about 80 basis points compared to last year, hitting 26.4%, driven by that revenue growth and also cost improvements from the cloud migrations they're doing globally.
Right.
They expect to see margins keep improving as they finish more of those migrations. They mentioned a tail of international cloud completions extending into 2026, mainly in Australia. And they're also seeing very high new product innovation internationally, which is obviously a key part of their overall global growth picture.
Okay, so wrapping things up a bit. Even with all these continued economic uncertainties,
Yeah.
they're basically maintaining their full-year guidance on that constant currency basis, right?
Mm.
Despite the Q2 beat. What does that signal about their confidence level, you think?
Yeah, it signals, I think, a balanced and prudent approach, as they put it.
We're doing right.
While the first half was definitely strong, they kept pointing to ongoing economic uncertainty. Weaker hiring trends that they saw emerge later in the quarter, uncertainty around interest rates, the impact of tariffs. It's all still out there. And the mortgage market, even though it was better than expected in Q2 overall, they said it actually saw a decline as they exited June and went into July. It kind of went back to that negative 12% run rate for hard inquiries that they've guided for the second half.
Okay. So the caution makes sense given that recent trend?
Exactly. This ongoing volatility just makes it hard to put a really precise number on future performance. So they're choosing to be, as they said, prudent and conservative in their outlook.
Right. And looking even further out, they actually reconfirmed their long-term organic growth target, that 7% to 10% range, and even gave a kind of scenario for 2030. What did that long-term vision look like?
Yeah, they did. They presented a really compelling base case scenario. And the key point was that they believe they can deliver their long-term financial goals even without any recovery in the U.S. mortgage market.
Without a mortgage recovery?
Yeah. In that scenario, they projected organic revenue growing at an 8.5% compound annual growth rate, reaching about $9.6 billion in revenue by 2030, with EBITDA margins over 35% and adjusted EPS around $15 per share by then. And in that world, they'd return about $2.5 billion to shareholders along the way.
That's a really powerful statement, isn't it, about the resilience and diversification of their business model, hitting those kinds of targets without needing a big mortgage rebound.
It absolutely is. And then just to show the full potential, they also laid out a scenario that does include a mortgage market recovery, getting back to the average volume seen between 2015 and 2019 by 2030.
Okay, what happens then?
Well, in that case, 2030 revenue could grow to about $10.8 billion, which is an 11% compound growth rate. Adjusted EPS could be around $19 per share, and they'd return an extra billion to shareholders for a total of $3.5 billion.
Right.
So it really underscores the idea that any mortgage market recovery would pretty much flow straight through to their margins and EPS growth. It represents significant potential upside for the company down the road.
So, okay, after this whole deep dive into Equifax's Q2 2025 performance, what does this all mean for you, the listener?
Well, we've really explored how a company like Equifax uses these massive differentiated data sets combined with advanced AI capabilities to power really critical decisions. Decisions made by financial institutions, employers, government agencies, globally. It really is. And this profound reliance on data, it does raise an important question, I think, for you to consider. As all these organizations increasingly depend on vast amounts of data to assess eligibility, manage risk, drive their own growth, how does this growing reliance on data ultimately impact the individual consumer? Your agency, your access to opportunities in this constantly evolving economy.
That's definitely something to chew on, a really interesting question to leave folks with.